Avoid these 7 worst money habits which are actually keeping you poor. The seventh habit has made many people go broke and poor. Thus, you must watch this video till the end to know it. Now let's start. Number 1. Improper allocation of resources. Without a clear plan for your finances, it's simple to waste your resources. Uncontrolled discretionary spending can diminish the funds available for critical expenses, such as housing costs, bill payments, credit card debt reduction, student loan repayment, or retirement savings. It's important to recognize that you don't need to cut out all discretionary spending entirely. Enjoying life includes allowing yourself the occasional indulgence, whether it's traveling, dining out, or attending concerts. The objective is to achieve equilibrium, ensuring that discretionary spending occurs only after all necessary expenses have been addressed. It is advisable to refrain from using credit cards for shopping. When shoppers use cash or debit cards, they often find themselves spending less than when using credit cards, as the tangible nature of cash creates a stronger perception of losing actual money. Take a moment to consider your purchase. Before making a significant non-essential purchase, particularly one driven by emotional spending, take a moment to evaluate whether it is a necessity or a desire, and assess your financial ability to afford it. Number 2. Failing to establish an emergency fund. Emergencies, such as a broken leg, car accident, or a sick pet, can result in significant financial setbacks, potentially costing you thousands of dollars. An emergency fund serves as a financial safety net, providing you with the necessary resources to address unforeseen expenses that may not align with your standard budgetary allocations. In the absence of an emergency fund, unexpected expenses may compel you to incur high-interest debt or fall behind on essential payments, potentially jeopardizing your financial stability and creditworthiness. Consider establishing a dedicated account for your new emergency fund. This strategy will assist you in preserving your funds for long-term objectives rather than using them for everyday expenses or alternative savings aspirations, such as a vacation. Establish a target amount for your emergency fund savings. While individual circumstances may differ, it is commonly advised to allocate funds equivalent to 3 to 6 months of living expenses for financial security. Subscribe to our channel and also press the like button to know more financial tips. Number 3. Utilizing your credit card to its fullest potential. Maintaining a low credit card balance, or ideally having none, can positively impact your credit score. However, accumulating significant balances or surpassing your credit limit can lead to serious consequences. A transaction that exceeds your limit could be declined. However, if you maintain a solid payment history or have chosen to enroll in over-limit protection, it may still be approved. However, should the process go through, be prepared for associated fees, an increased interest rate, and elevated minimum payments, along with the potential for account cancellation. Although it is possible to utilize the full limit of your card, doing so can negatively impact your credit score if you approach that threshold too closely. Your credit score takes into account your credit utilization rate, which reflects the proportion of your available credit that you are currently using. Excessive use can create an impression of risk and overextension, ultimately negatively impacting your score. Maintaining a credit utilization ratio below 30% is optimal. Generally, a lower ratio is more favorable. Consider a scenario where your total credit limits across multiple credit cards amount to $10,000. It is advisable to maintain your balances at or below $3,000 for optimal financial health. Number 4. Maintaining an outstanding balance. In the early days, credit cards were essentially charge cards. This approach facilitated credit transactions, requiring the total balance to be settled monthly, which encouraged customers to spend within their means. While only a limited number of cards operate under this model, it is advisable to pay off your balance in full each month to prevent incurring interest charges. In today's financial landscape, it's possible to maintain a balance from one month to the next, allowing you to make only a minimal payment instead of settling the full amount. Here's the important detail: making only the minimum payments, particularly on larger balances, has a minimal impact on reducing your principal. In the meantime, you incur interest charges that increase your total balance and extend the duration of your debt. Maintain a lifestyle that aligns with your financial capabilities. Utilize your credit card for purchases that you can promptly settle to reduce or eliminate interest charges. For significant expenditures, it's advisable to accumulate savings and make the purchase in full. Utilizing a credit card and incurring interest charges for carrying a balance can lead to substantially higher costs over time. Consider contributing more than the minimum payment. Number 5. Failing to set aside funds for future needs. Regardless of the reasons behind your lack of savings, whether it's difficulty in accumulating funds or a preference for enjoying the present, this oversight can lead to significant challenges in the future. For instance, the challenge of being unable to purchase a home. Postponing retirement may lead to a less comfortable lifestyle in your later years. It can also hinder your ability to support other financial commitments, such as funding your children's college education. Additionally, insufficient savings can leave you exposed to the risks of accumulating debt. Interest-bearing savings appreciate over time thanks to compounding interest, and investments typically tend to rise in value over the years. Delaying the initiation of your savings and investment journey reduces the opportunity for your capital to appreciate over time. Optimize your returns. Traditional savings accounts typically offer minimal interest rates. Therefore, it's advisable to consider options that provide higher returns, such as high-yield savings accounts, certificates of deposit, and money market accounts, whenever feasible. Number 6. Failing to adhere to a budget or neglecting to establish one altogether. Budgeting serves as an essential tool that enables you to gain clarity on your monthly income and expenditures. This approach facilitates maintaining a budget and achieving your financial objectives. Without a budget or adherence to one, you may find yourself living paycheck to paycheck, potentially leading to insufficient funds for essential bills. Creating a budget allows you to strategically allocate your funds to cover regular expenses while also prioritizing savings and debt repayment objectives. Your budget can certainly accommodate enjoyable elements, such as savings for vacations or entertainment expenses. It is essential to include these items, along with any others, in your budget. The objective is to ensure that you have sufficient funds to meet your expenses and spending, thereby avoiding overdrafts and the accumulation of debt. Budgeting can be tailored to align with your individual preferences. You have the autonomy to determine if your approach is intricate or straightforward, whether you prefer utilizing an application, a spreadsheet, or traditional paper, and if you opt for card management or cash stuffing methods. Number 7. Failing to optimize savings accounts. While you may be doing well in establishing an emergency fund and saving for the future, it's important to remain vigilant in choosing the right account type for your savings to avoid developing poor financial habits. Maintaining your savings in a traditional savings account may not be the most effective strategy for growing your wealth, as these accounts typically offer minimal interest earnings. Consider transferring your funds to a high-yield savings account, as it offers a greater interest rate, effectively increasing your earnings and accelerating the growth of your balance. In certain circumstances, failing to select the appropriate accounts may result in extended timelines for achieving your objectives or incurring higher tax liabilities. Watch the video appearing on the left side to know if a person is secretly rich. Also, subscribe to our channel to help us complete our goal of 10,000 subscribers.